Decision trees. Decision trees. Decision trees. Decision trees. Decision trees. Can I proceed? Decision trees. Can I proceed? Yes, I can proceed. Decision trees. Decision trees are trees that helps us make decisions in capital budgeting. These are trees that we draw that helps us make decisions. So a decision tree is a visual and analytical tool that is used to make decisions or are used to predict outcomes based on series of choices or conditions. It's a visual representation of decisions, or that there's a visual representation or a tool that we use to make decisions or to predict outcomes based on a series of choices or a series of conditions. And this tree is structured. It's structured like a tree. Let me say it that way. It is structured like a tree. The visual representation of this visual is structured like a tree. It has branches, it has roots. Tree. We know a tree candidate has roots. We have the branch, that's the stem. This is the ground. We have roots here. We have the branch. We have branches like that. All right. This is a tree. So the decision tree that we use in capital budgeting is structured like a tree. It has branches, which represents different possible paths or conditions. You understand? So the decision tree has various components. Just the same way a natural tree has roots, a decision tree has a root node. A decision tree has, just like a natural tree, a root node. Components. What are the components of a decision tree? The first one is a root node. One root node. Take that shape. That's the shape of a node. A node. You understand? That is the starting point of the decision tree. Just the same way the root of a natural tree is the starting point. We have a root node, which represents the initial decision or problem. The root node represents the initial decision. Then you have decision nodes. Decision nodes. You take that shape. That is the shape of a decision node. It's a circle. So these are internal nodes where a decision or choice needs to be made based on certain criteria or condition. So you may have something like this one. The decision tree, you may have that being the starting point. Then you may have nodes. So this is the root. Then from this root, we have the decision nodes. And I've said these are internal nodes where a decision or choice needs to be made based on a certain criteria or conditions. Then, of course, we have these branches. These are branches. Branches. Okay, a tree must have branches. So we have the third component, branches. Branch. A branch. These are paths. Paths that are, or roots. Paths. 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 This one. You know, paths can be this. I'm referring to path, root. Okay? When I say root, I'm referring to, again, this root, not this. Path. So a branch is a path. So a tree has roots, it has nodes, then branches, which are paths. All right? That lead from decision nodes. They do what? They leading from decision nodes. This path, this branch is leading from a decision node. Leading from decision nodes, representing the possible outcomes or choices. So this represents the choices, possible outcomes. You understand? Then we may have the leaf nodes. We may have the leaf nodes towards the end. Okay? Leaf nodes. Leaf nodes. We may have the leaf nodes. Leaf nodes. What are leaf nodes? Now, leaf nodes are the terminal nodes representing the final outcomes or predictions. You understand, candidates? So these are the components. So I've said, candidates, that decision trees start at the root node. They start at the root node. Decision trees do what? Start at the root node. The process begins at the root node, which represents the main problem or decision to be made. Then we progress to evaluating of conditions at the decision nodes. The decision nodes, candidates. At each decision node, a specific condition or criteria is evaluated, and the outcome of the evaluation determines which branch to follow. This one determines which branch to follow. So the possible outcomes are laid out in the tree. Then it's possible to determine which path to follow, which branch to follow. So based on the evaluation at each decision node, we follow the corresponding branch until we reach the leaf node. And we say that leaf nodes represent the final outcomes or predictions based on the series of choices or conditions that are evaluated along the path. So that is the theory part. If you've not understood, you will understand as we work out an illustration. But of course, how can you not understand that a tree has roots, a tree has branches, a tree has leaves? How can you not understand that, candidates? Let's move on to a straightforward illustration. So the example reads, a company is considering investing in a new product line. The potential outcomes depend on the market response, which can be either favorable or unfavorable. The initial investment required is 500,000 shillings. There is a 50% probability of favorable market and 50% probability of unfavorable market. If the market response is favorable, there is a 70% probability of generating 800,000 net cash flows. Or present value cash flows, and the 30% probability of generating 400,000 shillings. If the market response is unfavorable, there is a 50% probability of generating 200,000 shillings as present value cash inflows and 50% probability of generating 100,000 shillings. I'll take it again, slowly but surely. A company is considering investing in a new product line. The potential outcomes depend on the market response, which can either be favorable or unfavorable. The initial investment required is 500,000 shillings, or mafaranga, if you like. Let's say 500,000 mafarangas. Right? There is a 50% probability of favorable market and 50% probability of unfavorable market, 50-50. If the market response is favorable, there is 70% probability of generating 800,000 shillings. Probability of generating 800,000 shillings or mafarangas as present value cash inflows, and 30% probability of generating 400,000 mafarangas. If the market response is unfavorable, there is a 50% probability of generating 200,000 mafarangas as present value cash inflow, and 50% probability of generating 100,000 mafarangas required. Using a decision tree, advise whether the company should invest in a new product line. Using a decision tree, advise whether the company should invest in a new product line. So, what is the root node? The root node. Here it is. It begins here. The root. You draw the root. Solution to the problem using decision tree. We said that the first thing to do, the first component, is the root node, the starting point of the decision, the root node. the starting point of the decision, the root node. The root node. That is the root node. The root node. The starting point of the decision tree. The root node. And we've said that it represents the initial decision or the problem. What is the initial decision or the problem? Do I have the question? A company is considering investing in a new product line. The potential outcomes depend on the market response, which can be either favorable or unfavorable. The initial investment required is 500,000 mafarangas or shillings. Listen to that language. The initial investment. So the root node represents the initial decision. What is the initial decision? The initial decision is the initial investment. And this is the initial investment of 500,000 mafarangas or shillings. 500,000. Initial investment. That is a cash out. If you are to invest, this is the money you will have to, flow out. It's a cash outflow. 500,000. Initial investment. Then we read there is a 50% probability of a favorable market and a 50% probability of unfavorable market. So those are two things, okay, that will spring from the root. So we have 50%, 50%. 50%, this is 0.5, convert into decimal, 0.5. Favorable, unfavorable. Favorable, unfavorable. 50% favorable, 50% favorable. There is 50% probability of favorable market and 50% probability of unfavorable market. So these are branches that are leading us to nodes. We're going to have decision node. Okay? So you'll have decision node there, decision node here. Let's proceed. If the market response is favorable, this route, we are taking the first route. If it's favorable, what happens? If the market response is favorable, there is a 70% probability of generating 800,000 mafarangas or shillings. 70%. And 30% probability of generating 400,000. So we have 70, 50. That's so? Yeah. Yes, we have 70%, 70%, converting into decimal, that gives me 0.7. This one gives me 0.3. So there is 70% probability of generating 800,000. This is possibility of generating 800,000. 70%, 800. 30%, 400. If favorable. All right, that's what we read. If the market response is favorable, after investing the 500,000, if the market response is favorable, then there is 70% probability of generating 800,000 shillings and 30% probability of generating 400,000 shillings. But if the market response is unfavorable, we come to this route. If it is unfavorable, what happens? If it is unfavorable, there is the probability of 50%. 50% converted into decimal is 0.5. Let me use my black pen. 0.5. 0.5. 0.5. 0.5. 0.5. 0.5. 0.5. So there is probability 50% of generating 200,000, and 50% probability of generating 100,000. So that is the tree. We have drawn the tree, but we are required to advise the company. Should the company invest in a new product line or not? But that is how you draw the tree. Is it clear? Gapno, Fred, Andres, Felista, Ahensi, Sarah? Yes. Gapno says that's clear. So we are required to advise. Geoffrey, are we together? Are we together? Are we on the same page? Are we on the same page? So look at the board. We are not going to perform a back pass. Okay? %80 probability. 70% probability the company will generate 800,000. 30% probability the company will generate 400,000. 50% probability the company will generate 200,000. 50% probability the company will generate 100,000 if unfavorable. So we have to calculate how much will the company generate if the market is favorable. Okay? So what is the expected amount if the market is favorable? So number one, you have to calculate the expected amount the company will generate if market is unfavorable. And it is simple. It is 0.7 times 800,000 plus 0.3 times 400,000. How much is it? Then we come to unfavorable. The expected amount the company will generate if the market is unfavorable. So we'll take 200,000 times 0.5, 0.5 times 200,000 plus 0.5 times 100,000. How much is it? So those are the amounts we'll have at this point and that point. Give me the figures. What is the favorable expected value? Favorable expected value. Gano. Is that P silent? Gano. I think it's silent. Gano. Felisa says 680,000. 680,000. 680,000. How about the expected unfavorable value? Expected unfavorable value or amount. Felista says 150,000. 150,000. Is it true? Can someone confirm? Yes, someone has confirmed. Yes, 150. 150,000. So this is the expected favorable value. Let me use my red pen. Expected favorable value at this point is 680. That times that plus that times that, 680. That times that plus that plus that is 150. 150,000. So after calculating the expected favorable value and the expected unfavorable value, we can now then calculate the overall expected expected and given that these are net cash inflows, we read these are present value cash flows. So the expected net cash flows or present value cash flows, all right, the overall expected amount, or even the overall expected, let me say NPV, because these are inflows. We get the difference between these two inflows after taking into consideration the probabilities we deduct from the initial cash outlay. You understand? We know NPV candidates is equal to present value cash inflows minus present value cash outflows. The outflow is the 500,000. So the inflow will be the 680. This will be equal to 680,000 times 0.5 back pass. Then the 150,000 plus 150,000 times 0.5. These two comprise the present value cash inflows. The question candidate is simplified so that I want you to concentrate on the concept. All right, I want you to understand the concept first. So these two are cash inflows, present value cash inflows. That means that the values have already been discounted. So the present value cash inflows minus the cash outflow, the initial cash outlay of 500,000 will give us the NPV, which will be either be positive or negative. $85,000 negative. 85,000. So the NPV is equal to 85,000 negative. So what is the advice? Advice. Should the company invest? Using addition tree, advise whether the company should invest in the new product line. Obviously, the company should not invest in the new product line. Why? Because of the negative NPV. Is it clear to you, candidates? Have you understood decision trees? Have you understood decision trees? Yes. Now, for those of you who will be appearing in exams, decision trees questions are the questions that you should plan to do, because it takes a very short time if you know how to draw the trees. There was a question that was tested, I think, in August 2023, and there are also other sittings where we have had these kind of questions. So please practice on decision trees. As we move along, we'll have time to answer some of the past paper questions, though some of them, all of them, we've answered them anyway. We've done all past paper questions, including the most recent one. All solutions have been provided. So make sure you practice. So this is the idea behind decision trees. What makes candidates not to answer questions of this nature is because the examiner now may bring in a bit of complications in calculating the present value cash flows and all that. So that requires a bit of exercise, because every question, if you have to look at the past papers, every question is unique. You understand? So try and answer all questions on decision trees. If you intend to sit the next exam, such a question should be one that you do fast, because such a question you can earn the 20 marks in less than 15 minutes.